Okay, so the principle we're talking about today is the difference between amateur and professional status. Now, a lot of you are going to scratch your head. Please make no mistake. This is not an attempt for me to you know boast my horn or whatever. It's actually something I've over the years now of loads of experience, it's something I've actually come to understand. So I'm sharing this with you in hope that you will also understand this today and hopefully as you develop your career further. Now, the major difference between what professionals do and what amateurs tend to do is the approach. Okay, that's going to sound a little bit nonsensical and it's going to sound very, oh, okay, that's pretty obvious. But let's look at what I mean by the approach. Okay, amateur traders tend to focus very much on levels. Okay, whether that's a breakout trade level, whether that's a support and resistance level, whether that's a trend line level, whether that's a VWAP, whatever it might be, they tend to have these levels in mind and they write them all down and they've got them all there and they're aware of all of these levels. And now that is a good thing, don't get me wrong, you have to know the levels. However, what professionals tend to do is they tend to combine the levels with the interaction. Okay, so what I mean by that is that let's take, for example, there is a breakout. There's a big resistance area you've identified in the FX market. Call it R1. It's a major level. It's been holding for a number of days, etc., etc. What the professionals do so incredibly well is they are aware of the type of interaction that's required in order for that to be a successful breakout. Okay, so they focus primarily on the interaction once we approach that resistance level. Okay, and that's the real key, is that day in, day out, when you're looking at these levels, if you learn to focus on the interaction taking place, then you're going to learn to develop an understanding as to when you have a good breakout, when you have maybe not a good one, but an okay breakout, and when you have a weak breakout, which is a potential for reversal. And that's the fine art, guys. That is what differentiates, and again, I don't want to use that word professional. That's what differentiates guys that make money over the years and guys that end up getting washed out. Okay, now, like I said, with an exclamation mark, that's how I used to trade. Okay, I used to be the level guy. I'm the guy that knows all the levels. Okay, I can post 101 charts for you and show you all the pretty levels. Don't get me wrong. Okay, but what I can't teach and what I can't show you at the end of the day is what the interaction is required at those various levels and those various trade opportunities you're taking on. Okay, so why does it work better this way? Why does it work better to combine the interaction with the levels? Well, it's very simple. Number one, confirmation. Okay, confirmation is another word for confidence. Okay, when you have confirmation or confidence, you can then leverage. Okay, in other words, if you have an understanding through experience that when X, Y, and Z occurs, there's an 80% chance that this is going to continue. Well, you can leverage up there. You can put some real big size on that opportunity. Okay, so that's the first most important reason. The second is risk management. Okay, and these two go hand in glove effectively, leverage and risk management. Because if you know what should occur, in other words, in terms of interaction, the minute it doesn't occur, guess where your stop is? Okay, and that's the real key. It's not a case of, I remember when I first started trading, it used to be, oh, if you had a pin bar doing this, you put your stop down here. No ways. Okay, why do you need to take an extra 6 or 7 or 8 tick stop? Right? When that interaction shifts, when that interaction is not what you expect it to be, just get out of the trade, flatten, take the risk off. And that's the real key, guys. That's what really differentiates, lasting in this game and really making good money and just getting by. Okay, it's all got to do with learning that interaction. So the key question most of you are probably wondering is, well, how do you learn interaction? Okay, well, what I'm going to say is it's not going to happen overnight, and I'm not going to be able to teach it to you. You're going to have to teach it to yourself. But I can show you what this interaction looks like and how you can begin to develop your own understanding of this interaction. But remember what I said, this is not going to happen overnight. You've got guys that I sit around with that have been doing this for 10 years now. Okay, they got 10 years ahead of you, but they got 10 years times 10 hours a day. You do the mathematics. They got so many thousands more hours of understanding about the interaction ahead of you. So it's going to take time. Right? But if you're willing to invest and you really want to make a career of this, you have to combine the levels with the interaction. Okay, so examples I'm going to show you with this approach is the German 10-year Bund. Okay, the date this is taken on is the 4th of October 2018. And after that, I'm going to show you an example in the Treasury note, so the T-note 10-year. So we're talking bonds today, effectively. Now, let's start off with the German Bunds. Okay, so what you have here is a footprint, but I don't want that just yet. Okay, so like I said, the levels is the important thing to understand. Now, one of the key strategies you talk about in the volume profile course is this concept of gaps. Okay, so we can see very clearly overnight on the 3rd of the 10th, there was a gap. Okay, 158.37. The market opened this morning with a gap as well. Okay, so the German Bunds opened below the range yesterday, initially sold off, came back, and then filled in that gap. Okay, now the trade we were looking for was short trades. Why? Well, very simply, when a market fills in a gap but cannot continue inside of that range. In other words, once the market attempts to come back in range but fails, right, it's telling you a lot about the nature of that market. Okay, one, it's imbalanced, but two, it's failing to even re-enter the previous day's range, which is quite bearish in its own. Okay, so what we were looking for was short side trades once we had failed to get and close above those 158.21s. Now note what I said. I identified an opportunity. This is a strategy I've developed obviously in the market profile course, but I've developed it over a number of years. Now what I used to do was I would just go and sell it. As soon as it failed above the 21s, came back in, I would just get short. Okay, and sometimes that works, sometimes it doesn't. Sometimes I end up stopping out at the high. Sometimes what I end up doing is just, continue selling it all the way up because I've lost the plot and I've lost focus of ultimately what the trade opportunity is. Okay, so what I found through making this mistake and losing this money was instead of just when it fails to get above that into that previous range, rather than just sell it, let the market tell me when those sellers are entering. Okay, and for that I'm going to show you what this looks like on the footprint. So it's a timing thing, guys. It's important to have the strategy, know the levels, know the areas, but the timing is the key part because the timing allows you, like I said, leveraged opportunity and risk management. Okay. So what you can see here, this is a footprint chart. Now I use the footprint because it allows me to view those interactions in slow motion. Okay, a lot of professional traders use the ladder or the DOM or the depth of market, whatever you want to call. But for me, the ladder is too quick. There's too much noise on the ladder that I can't always observe. Okay, yes, the ladder can be very, very good when you're playing for breakouts, momentum. But for me, when I'm trying to observe that shift in interaction, that's when I prefer to use the footprint chart. Okay, so what you're looking at here, each one of these bars is 5 minutes in time. Okay, now I just need to get to the important part. So we can see we made a high around about 8.35. Market came up, made a high. We saw a little bit of selling. Okay, we can see that with a negative delta. So the market came up, good volumes as well. Note the volumes. Okay, good volumes, but it got sold back down. All right, now the first time it got sold back down off of the high, notice what we saw here at 158.09, 1,184 contracts absorbed. In other words, there was a real buyer there that took everything. Notice what the market did in the next rotation. So the minute the market identified that buyer, it very quickly went bid. Note the lack of trade on the bids. 4 lots, 15 lots, 1 lot. Okay, so the market quickly went bid up, navigated away from that buyer. So straight away when I saw that, I put that red line. Okay, because straight away that says someone absorbed that price at 158.09. Market then went and made a new high. Again, for the second time, got sold. Okay, so obviously I'm licking my chops here and thinking, oh my goodness, it's twice now I've seen a seller come in off of the top. Does that mean I missell? Potentially. Potentially, yes. But where am I wrong? Okay, well, unfortunately, if I'm going to play the old way of just selling it because there's a seller, well, I've got to stop out at 29s and 30s, which means if I'm getting short somewhere around 15s, I'm taking 14 ticks of loss. Okay, now for some people, okay, that's fine. But for me, when I want to leverage a trade, there's no ways I'm going to take 14 ticks to stop. Not if I'm only going for 14, 15, 20 ticks. Okay, and that's where I have to wait for that interaction. So let's play this on. Let's see what happens. So we can see the market comes down to 58.09 a second time. Notice what happens now. Only 88 lots trades this time. Okay, 1 tick higher. What happens the next time? Market sits for another 20 minutes. We come down again. This time 253 lots, and it goes back bid. Okay, so we can see on multiple occasions, once, twice, 3 times, 4 times, someone came in, sold it into there. There was a buyer sitting there, and then it went back bid. And this is the change in the interaction. Here it comes. Look what happens in this rotation, the next rotation, once we take out the 158.09s. Okay, We take it out, but look at the volume pickup. Significant. Okay, we trade 10,000 contracts in that rotation. More importantly, we see 2,000 lots worth of selling. In other words, someone came in and initiated through the 09, sold aggressively through the 09s. But he also sold in size, and that's key. Okay? Because if he's selling aggressively and he's selling in size, it means he's got more to come. And that's where I initiate the trade, because now we've broken below that 158.09. I can see the seller off the top, so twice I've seen the seller off the top, but now I can see the seller interacting very differently. In other words, he's holding an aggressive position now. He's entering the market aggressively. Now I want to enter short, and I get short on the 09s, retest of that 09 level, stop simply goes above the 14s. We've got a 5-tick stop here, guys, a leverage stop. And the market then rotates all the way down to 89s. Okay, 20 ticks. Very aggressive. Now, to put that into perspective, the range in the day was about 80 ticks. So yes, a lot of you are going, yeah, but it's only 20 ticks. It's not my game. Okay, professional traders are not in the game to use one lots. We're in the game to use leverage positions. Okay, that's the hard fact. That's why, there are guys that can make 7 figures a year. It's because we use leverage. That's our game. But in order to learn to use leverage, you have to learn the art of risk management. In order to learn the art of risk management, you're going to have to learn the art of interaction. Okay, so it's all one and the same thing, guys. Now, the second example I want to show you, if you don't yet believe me, let's go to the T-notes. Okay, so T-notes, day 2 trend. If you're watching the T-notes yesterday on the 3rd of the 10th, obviously we're above 2.2%. Very aggressive sell-off in the T-notes. So I just want to bring this T-note up. Okay, so we can see this is yesterday's sell-off. This is a 30-minute chart. We can see the sell-off there, and the market's now trying to go bid. So we can see a little bit of a bid up coming in the Treasury 10-year note. Okay, so what we're looking for today is shorts. We're looking for some opportunity for shorts. Okay, this is part of a strategy. We know we need to be short. The question is how, where, and why. Okay, so we know the levels. We've identified the levels. But again, selling blindly at a level, yes, okay, it's going to work sometimes it's not, but you're not going to develop the consistency. More importantly, you're not going to be able to use leverage. So let's look what the charts provided us with. Now, again, the footprint was fantastic today in this sense. It's funny because, it's one of the first times in a long time that actually I was paying so much attention to the footprint that I actually got scared out of most of my position, which is a bit frustrating. Okay, and what ultimately happened, I'll explain it to you, was we saw a risk off in the S&P 500. It sold off 35 handles. Okay, so you can imagine with that risk off in the market, with the T-notes going bid, with being 7-8 ticks aside with a leverage position, it was uncomfortable. So the moment I got the relief pressure and we finally got the sell-off, I just wanted out. Okay, again, that's me having to work with my psychology. But let me show you what the interaction looked like in the 10-year. Okay, so first things first, we can see the pits opened, straight away went bid. Okay, this is the pit open at 130. We can see market straight away went bid up. Now, we traded into these 31s, which was the high of the session. Straight away got hit down. Okay, we can see 10,000 offer. Really, really aggressive sellers stepped in already at 31. So we saw it once. Market went bid again. And again, we saw the seller step in. Market went bid again. And again, 3 times, the seller stepped in. Okay, so every time price went bid up, okay, in other words, the seller wasn't selling on the way down. The seller would sell when prices were high. He would take the price all the way back down. He would stop selling. The market went bid, and then he would repeat. He would sell all the way back down. Now, the real key to understanding this interaction is all about absorption and auctioning. Okay, we talk a lot about that in the footprint course. So, absorption auctioning is what was occurring here. In other words, the seller was taking and being aggressive at high prices. Okay, and absorbing whatever he could at high prices. The minute the buying stopped, he would sell it back down. Okay, we saw that once, twice, 3 times. Then we saw some really aggressive absorption. Now this is really, really key. This is the nuance of the interaction. We saw 20,000 contracts of net delta at the high of the day. But what did price do? It didn't shift more than 2 ticks. Okay, so in other words, we have an area where sellers have stepped in 3 times. The market then sits on the high. We absorb a lot of volume, but prices can't move higher. So what's that telling us? It's telling us that seller is still sitting there absorbing everything the buyers are willing to give. Eventually, okay, and remember guys, a lot of that buying was led by the risk-off tone. Eventually, we saw that risk-off tone ease a little bit, And straight away the buying stopped. And when that buying stopped, notice what's happened. The sellers step in and they initiate all the way down the page. Okay, now to put this move into perspective, we're talking about a 50% of the day's range. Okay, guys, and that was it. It was, that was the real key. I mean, for me, I had already been selling it over a year. Okay, so I'd been selling it at 145. The move only actually eventually went down at 345. 2 hours of absolute torture. Okay, absolute torture. But had I just focused on the interaction, focused on that footprint, right, that would have ultimately given me the timing in order to initiate the leverage positions. Okay, guys, that's the takeaway from today. That's our little lesson today. Hopefully you've caught on something there. And again, all I want to say is it's all about interaction plus the levels. Most of you guys, most of the retail traders, they're fantastic technicians. You're fantastic at the levels. You're fantastic at interpreting charts. What you're not so skilled at is learning about that interaction, learning about timing. Okay, if you want to do that, the footprint course is for you. All right, now templating is very simple. I'm going to very quickly go through this. All templating is it allows us to look at the same strategy and ask a number of questions about that strategy, and over time learn all the nuanced variables about that strategy. Okay, now in the footprint course, we go over every single one of these variables with every single strategy. Okay, so that's what it's about, and you can see some of the variables we talk about are trending and consolidation in terms of market context. In terms of market conditioning, we talk about things like liquidity and volatility and which participants. Okay, so let's put this into today's example. Right, when we saw those T notes at the high there, those types of time frame participants are large. Okay, to do that sort of absorption and auctioning, it has to be big players. Okay, they're not small. They're not algorithms. They're big players. Right. Equally, liquidity is extremely high. Some people are taking liquidity, some people are providing. Right. Every one of these variables gets discussed extensively in the footprint course. Okay, so our question for this week. Sometimes the footprint is very noisy and nothing seems to make sense. Is this normal? And am I looking at too many things? The simple answer is it's sometimes too noisy for me too. Okay, so this ties in quite beautifully with today's lesson. If you want less noise, learn to identify either certain levels or certain strategies. In other words, like I said, if you want to learn the support and resistance trade, you only want to be focusing on that interaction when we approach that level. Okay, that way you're zoning into the footprint when we're approaching key levels or when a key strategy is being initiated. Right, that way you're not going to just be almost thumb sucking and picking up on noisy opportunities. Alright, so that's the way to really get away from being distracted. And remember, guys, most important with everything in life, less is more, and it's the same with trading. There's a lot of noise out there, so have your levels, have your trade strategies, and go and use the footprint tool for interaction at those various trade levels and trade strategies.